For the last 50 years, you've paid a guy in a suit 1% of your money just to do math you didn't want to do. Well, guess what? By 2026, that guy is a ghost. The traditional financial advisor is facing an extinction-level event. And that first wave of change, the Robo-Advisor, that's already old news. To really get where we're going, we first have to understand where we've been, an era that was less about numbers and more about, let's just call it, astrology for men who wear cufflinks.
I mean, that's really what investing used to be. It was all run on stories, narratives, and gut feelings about a company's CEO or how a stock just feels. It had way more to do with who told the most convincing story than it did with any actual data. And this whole setup created this massive, unspoken conflict that's been raging under the surface of Wall Street for decades. On one side, you have the old guard, running on hunches and pure ego. And on the other, you've got the new school, armed with probabilities, patterns, and algorithms. This isn't just some new strategy. This is a full-blown war of philosophies.
Yeah, let's call this the Gordon Gekko era. This is when advisors got paid and paid handsomely just to craft a good story. Whether that story actually turned out to be right or wrong was almost, secondary. As long as it felt human, as long as it was compelling, the money just poured in.
But then the math nerds showed up. We're talking PhDs from the best universities who looked at the market and didn't see a bunch of stories. They saw a massive data set, just packed with statistical patterns and behaviors that humans repeat over and over again. They figured out that markets weren't totally random, and that little insight, that was an edge they could absolutely exploit. So the most infamous and, frankly, secretive of these new players was a firm called Renaissance Technologies, and specifically their Medallion Fund. It was founded by Jim Simons, a guy who used to be a code breaker, and it ran on one simple but totally revolutionary principle: use pure mathematical models to predict where the market is going. No egos, no stories, no guys yelling on TV, just cold, hard algorithms.
Now, to really get how insanely well this worked, we need a baseline. So let's take the undisputed king of story-driven investing, Warren Buffett. The man's a legend, right? He's averaged about 19% a year over his career. That's a phenomenal achievement.
But then you look at the Medallion Fund, running on pure math. It did something that just seems impossible. It generated over 60% a year before fees for more than 2 decades. Even after their high fees, it was still around 39%. The math nerds weren't just winning, they were absolutely lapping the field. And this is where that difference becomes totally life-changing. Over time, that gap compounds into this astronomical advantage. Let's say you put 10 grand with Buffett. You get over $300,000. Fantastic, right? But that same 10 grand with Medallion's math becomes 7 million. This insane outperformance actually has a name: algorithmic alpha. It's the profit you make when you see the world as a probability puzzle, not a storybook. So while the quants were just crushing it at the high end of finance, a similar kind of parallel revolution was starting to brew for the average investor. People started looking at their own advisors and realizing, hey, the stories are great, but they aren't actually adding up to better returns. In fact, it was usually the exact opposite. Study after study started to come out showing the same brutal truth. Something like 90% of active fund managers, the storytellers, consistently failed to beat their own market benchmarks over the long run. The data was just undeniable, and it kicked off this massive crisis of faith. And this led regular investors to ask a really simple but totally devastating question: why am I paying a premium for a story that ends up with me making less money? This single question is what lit the fuse for the explosion of low-cost automated investing solutions. The result was, it was an explosion. Global assets managed by these robo-advisors went from under $200 billion to nearly $3 trillion in just 6 years. And it's not slowing down. This isn't some trend. It's a huge structural shift driven by what the industry calls fee compression, which is just a fancy way of saying investors are flat out refusing to pay for underperformance anymore. So problem solved, right? The robo-advisor is the hero that saved us all from high fees. Well, not exactly. It was just phase 1. And like most first-gen tech, it came with a huge hidden flaw. Let's be crystal clear here. Comparing a quant fund like Medallion to a robo-advisor is like comparing a Michelin-starred chef to Chef Boyardee. I mean, come on. One is using these incredibly complex techniques to generate unique results, that's the alpha. The other is just mass-producing a cheap, standardized product. They are not even playing the same game. The whole promise of a robo-advisor is built on this idea of a bespoke experience. You know the drill. You answer a few questions about your age, your income, your goals, and boom, they deliver this personalized plan that they manage for you. It feels sophisticated. It feels tailor-made.
But here's the truth. It's not. It's not personal, not even close.
The reality is that all your thoughtful answers are just used to sort you into a pre-made bucket. You get slotted into a generic model portfolio that you share with thousands of other people who happen to give similar answers. This is not the hyper-personalization they advertise. It's mass market categorization, plain and simple.
So, you see, the real story here isn't about whether robos are good or bad. That's missing the point. It's about a much deeper force at play. Technology is making the entire concept of a financial gatekeeper totally obsolete.
For decades, the entire financial advice industry was basically built on this one principle: information asymmetry. The advisor had access to data, to tools, into markets that you didn't. You were paying them for that access.
And now, thanks to the internet, free market data, and all the research tools we have, that asymmetry is completely gone. It's dead. The gatekeeper has no more secrets left to guard.
Look, we've seen this exact pattern play out before. Travel agents vanished when you could suddenly book your own flight online. Floor stockbrokers disappeared when you could just click a buy button on a screen. Whenever technology makes access free and instant, the middleman just evaporates. Financial advice is simply the next domino to fall.
So this brings us to the final and most crucial point. The gatekeepers are gone. You literally have the power of a 1990s hedge fund in your pocket right now. So the question is no longer who you're going to pay to manage your money, but whether you have the tools and the mindset to become your own personal quant fund. Because in this new world, if you're still paying 1% for a generic bucket portfolio, you're not a survivor, you're a donor.